We have a great panel here. I'll just briefly introduce everyone, although they need no introduction. We have with us Maamoun Rajeh, President of Arch Capital, Christian Dunleavy, who's the Chief Executive of Aspen Insurance, and Scott Egan, who's also the Chief Executive of SiriusPoint. So we have a lot to cover, and then we also have a few follow-ups to the panel that my colleague Lee just hosted with Kevin. So we'll have an active dialogue and hopefully a vigorous debate for everyone. But the place I wanted to start is just the very macro level, which is that, the world is a riskier place now than it has been. Let's say, it felt like there was kind of a peaceful cycle for insurance for about 10 years post-crisis or so. Now we have geopolitical instability, we have the rise of artificial intelligence technology, we have different kinds of cyber threats. So it feels like a newer risk climate and sort of one where risk has emerged again. And yet, as Kevin mentioned, pricing is fairly benign and it's a fairly sanguine pricing environment. So I wanted to have us dissect that as a starting point. And let's just start with Maamoun and go around from there. What's going on right now?
Yeah, sure. Good morning, everyone. Great to be here. Just stepping back and validating the point you just made, we are most definitely in a heightened risk environment for all the factors that you just mentioned. But I think this industry is resilient, and I don't worry per se about products, verticals, like the idea that property cat events can't be handled in this industry, or particular terror or war risk, or where there's proven track record in handling sort of sleeves of risks. Over time, this industry has proven to do that pretty well. I think the widowmakers in this industry are sort of two things that come to my mind. One is casualty, and the other is this heightened risk environment that brings together hitherto thought to be uncorrelated product lines. Those two sort of dynamics are areas where the industry needs to focus. On the casualty side, by the time you wake up to a problem, you have a material problem. And a lot of the industry players that played in that market and picked up exposures in that market at a time when they shouldn't have are feeling that, because the dynamic in this business is you utilize that capital over and over again. And by the time you wake up, you have a number of underwriting years that have compounded to present you a problem. And the other side of it is it's sort of a 9/11-like event. And that event has suddenly become a whole lot more complex to dissect for all the factors that you just mentioned. So I think the challenge and the call out to the industry is we need to get more creative on our RDS scenarios. We have to kind of really reflect on what are those events that can compound, that can correlate, that can aggregate in ways that we so far haven't dealt with. And I think if we handle that well, we can cruise through this.
Christian?
I think, I agree with a lot of what Maamoun said there. I think maybe what I would add is we are in the business of risk. So a riskier world from a business perspective is actually a good thing. That means we have more products to sell, we're more relevant, we're more important. And as long as we can quantify, understand and kind of range bound the downside scenarios for some of those risks, which I think Maamoun spoke about there, that's actually really validating the utility of insurance to the global economy. And so from that perspective, we don't run away from risk as an industry. We actually want to run to that risk. The trick is being able to do that in a way that doesn't, blow you up. To Maamoun's point about the RDS scenarios, the realistic disaster scenario, which is what an RDS is for those in the room who don't know the jargon. The RDS for aviation, for example, wasn't even in the same universe as the Russia-Ukraine aviation scenario that actually played out with hundreds of planes being trapped. And so, we are kind of constrained by our own imagination, I guess, as to what some of these scenarios could be, which is why, having a well-capitalized industry, is important, because that excess capital usually isn't quite as excess as perhaps it might appear on the surface sometimes.
Compelling comment. Scott, anything there?
Yeah, look, without repeating what Christian and Maamoun said, I think there's a couple of dynamics around risk now. One is the speed at which risk can change. I think the velocity of that has definitely changed in the past decade. I think there's a second part, which is the connectivity of risk. You know, something happens in the other side of the world and it's like the butterfly effect. There's a real connectivity, and I think really, to reinforce the point that Christian and Maamoun both said, I think as an industry, we do have to lean into our modelling and our RDS modelling. I think California wildfires at the beginning of the year was a good reminder of that as well, where I would say, obviously, the modelling there is below par, it's below what it needs to be. And so those are some of the dynamics that we're dealing with, but the link is what you mentioned in your opening remark, which is to pricing as well. And I'm afraid, you know, we're in charge of that as industry leaders, as an industry. And so at a point of heightened risk, if we think it's a good idea to drop our rates or rate adequacy, as Kevin was in, then that's where I think we struggle. But there's a pattern of behaviour in this industry that keeps repeating itself every 5 or 6 years. So that's an interesting dynamic behaviourally within the industry as well.
Yeah, let's pick up on pricing. So at the FT, we sort of like to distill complicated thoughts into like a very simplistic form and then work from there. So when I hear pricing, I hear there's an excess of capital somewhere that's distorting pricing. And so, you know, we can kind of see it in credit markets at certain points right now because there's too much dry powder, right? So spreads have come in, and that's the way we think about what's going on in credit. But when it comes to the pricing environment, Christian, like, is it a sign that there's really too much sort of excess capital from these new entrants, private equity, private credit type players, and has that really been the driver of these changes in pricing that maybe aren't justified by the macro risk picture?
So I do want to be careful about talking about pricing, you know, when we're sitting with our competitors. But no, go on.
Yeah. Just lay out the next year's rates to this year.
I think the challenge that I think we have as underwriters is trying, you know, we're generally writing single year policies. And so you're looking 12 months out. And I think, you know, there is some psychology behind this as well as kind of the math that drives behaviors. And there's a recency bias. And so when you see after major cat events, you know, you see these, not always actually, but, you know, you see these spikes. We missed a few spikes in the late teens that I think some of us thought might have happened. The spike then eventually did come in 2023 and was a huge correction. But if you look at the data, the valleys are much, much, much longer, and in some cases lower than the spikes. And so, you know, how we think about price adequacy is important. You know, I think the incentives from the public markets, they can be pretty unforgiving for insurers who don't show growth.
Okay.
And there are times that I think they should be more forgiving on that, and they should actually incentivize companies who are showing that underwriting discipline when the market is turning. You know, but you've seen some pretty big moves on stock prices in the last year around just kind of revised growth expectations, and you know, the market is looking for growth, and so that balance there is tricky. The volatility is tricky, the growth dynamic is tricky, but at the end of the day, I think what you will hear from everybody is that as Kevin said, we prioritize, you know, defending margin and price adequacy over growth, and we're all looking to build book value over time. I think, you know, coming out of the experience that I've had at Aspen for the last 7 years since we went private, and you know, the mistakes that you make, you can make those mistakes very quickly. They take a very, very, very long time to clean up sometimes, and you can burn a lot of brain cells doing that. And it is a huge distraction that sometimes prevents you from participating in the actual, you know, moments when the market is actually quite attractive. So, you know, avoiding the big mistakes is important. And I think trying to flatten that pricing cycle is to everybody's benefit, frankly.
Yeah, Maamoun, I mean, is that a harder balance to manage when there's such a sort of wall of capital that's ready to move into the industry at any given moment?
Yeah, I mean, I think the law of economics applies to all, right? I mean, if you just step back, first, step way back, we're coming from a place where the industry reset the price of volatility, risk premiums, to a level that we haven't seen in a long, long time. So that's the starting point. And then you look at the dynamic of the returns that the industry has produced in the last couple of years. Look at just kind of the published return on equity so far this year, extrapolate a little bit for share buybacks and dividends. You end up with plus or minus 30 billion. Like, I don't want to blame the hedge fund or private equity influx. I think that's a broad generalization. I think just the incumbent market has materially more capital to deploy. And as Christian said, there's this dynamic that's playing out. Like, there used to be the day where you could be a niche underwriter, when you could be a specialist underwriter at Lloyd's, when you could be a niche specialist underwriter as a carrier, you stick with what you know. There's this pressure to broaden out. Christian mentioned it as well, this pressure to grow. And I don't think that's a healthy dynamic, but it's a real dynamic. And our investors have the choice. They can invest in this sector when the sector is ripping, and they can reallocate out. We can't control that. What we can control is just trying to grow book value, be reasonable, be creative for our clients, and try to make money for our shareholders. And there are times when you can do that, and there are times when you can't do that. Today, I wouldn't call it a soft market. There is a sentiment that's pushing the other way with supply of capital exceeding demand for capital. That'll play out until something else kind of another externality kind of comes in and kind of resets.
Okay. Scott, you brought up the pricing question. Yeah. I was sort of selfishly hoping someone was just going to blame private equity. It feels like we can blame private equity, private credit.
84% owned by private equity.
So. Yeah. But so, you know, how are you diagnosing it? Is it any different? And
no.
Okay.
No, I don't. I definitely wouldn't put the blame, and that's the wrong word, at private equity store. I think, look, there's a different sort of angle on our industry, which is from a consumer perspective, from a customer perspective. I think they want to know their risk carriers are going to be there today, tomorrow, and the day after. And I think more stability with an increasing risk environment. I think these things you have to put together. I think from an end customer perspective, that's a good thing. The second thing I think we have to recognize as an industry, and I think Maamoun talked about it perfectly, which in casualty, the truth is we don't know our cost of manufacture for a number of years. We don't make baked beans. Yeah, we can't sort of measure it at the end of every day, and therefore, you know, we have to be very careful, particularly in this fast-moving risk environment, that we're pricing for the risk as we know it today, but also the sort of retrospective element of that can change over time as well. And so I think the industry has enjoyed, I would say, meeting or slightly beating its capital returns. But let's not pretend that we're an industry that's made super profits, because I don't think we have. And if you look at it over any length of time, it depends what time you choose. If you choose the last 4 or 5 years, then you could probably say the industry's done quite well, but broaden that out to 10 or 12 years and you'll see that it starts to even out. And so, you know, we cause these cycles to ourselves as well. And you've always got options as to what you do with your capital. And if you can't deploy it, then you should return it, or you should do something else with it. And I think that's a much more responsible thing to do than actually drop the rate.
Maamoun,
Yes.
You seem to want to add something.
I wanted to throw one more thing in, and if I may, and maybe with a little edge to it. There is another dynamic that's playing out today in magnitude that we haven't seen in the past. I'll call out MGAs, and I'll call out fronting care. I hope I'm not offending anybody in the room. And it's a broad generalization.
But he's about to.
But on average, I believe my view is MGAs, fronting carriers, and broker facilities. MGAs have doubled in size, over $100 billion of premium. They're at peak volume and growing. And my comment earlier on specialists specializing versus generalizing applies to MGAs too. It used to be a time when a couple of really, really good underwriters could get together and do it actually better than the carrier. More agile, more specialist, more niche, more deep. Today, the incentives are misaligned. Again, generalization. Fees matter more than underwriting profit. Volume and growth matters more than underwriting profit. The argument to that would be, well, if I can't blow up my capacity because over time my MGA is worthless. My counter argument to that is most of them are looking to build and sell, and so you're going to get out before that happens. And the valuations around MGAs are just astronomical. So the incentives around that dynamic are real. Fronting carriers are growing at 20% a clip for the last 5 years. Once again, the minute you disconnect underwriting discipline from growth and volume and fees, I think you get into an environment that accelerates this lack of discipline, this price trending that's happening. And then broker facilities, again, there's a place for them. They add value in a lot of places, but by and large, they also take you a step away from risk underwriting, risk discipline, and the aggregation of risk accelerates price declines.
Okay, well, I think finally we've got someone to blame here, and I see, Scott, you nodding your head a lot.
I'm not nodding. He knew he was going to upset me. That was fine. Yeah. So look, I want to. I think I agree actually with some of what Maamoun said, but I think for me there's also a choice that you make, which is who you work with, right? And I know there was a generalism in what Maamoun was saying. Obviously I'm an owner of MGAs, and I actually partner with a lot of MGAs. The majority of our distribution, we've made that choice. We're incredibly selective about who we work with, and one of the things that I've always said to our investors, and I think it actually reinforces Maamoun's point, we turn away 80% of the opportunities that are presented to us, not because of numbers, but purely because that we don't share the same underwriting philosophy, the same skin in the game. And I think if you don't get that partnership
what are the key sort of factors you're looking for then? So let's drill down.
Underwriting skill, underwriting discipline, approach to risk management, skin in the game.
Okay,
so we've got nearly 90% of our relationships have economic skin in the game. So they're not just getting fee income. So there's a way of structuring these, but I also agree with Maamoun. The reason we turn away 80% of the opportunities that we see as a company is because of exactly what Maamoun said, which is there are people out there who just want to, we're close to Thanksgiving, so we just want to kind of fatten the bird for Thanksgiving and then move on, right? And we'll never work with people who just want to do that.
So I think the distribution, ultimately it's a distribution question, and what it really comes down to is how much of the dollar is left to pay for the risk that's being taken, and that's to Kevin's point that it usually ends well for MGAs and bad for balance sheets, right? Too much of every dollar of insurance, and I see VJ Dowling at the back of the room who has a great slide that he shows over the years on this, too much of every dollar is being used to pay for acquisition costs and expenses, and there's not that much left to actually cover the risk. And I think the danger of this kind of increasing power of distribution is that the only way the math works, if the acquisition cost continues to get pushed, or we don't find a way to dramatically pull in expenses, is that these MGAs have to outperform on loss ratios. And I would take the bet that they won't, because it is very difficult to outperform on loss ratio. And so in that scenario, there has to be kind of a ceiling on how much this distribution can take out of the dollar, so that the risk can actually be borne properly by the carriers, or there's going to be price escalation, which is bad for consumers at the end of the day. So there's a delicate balance here. We all pretty much, I think, do business with MGAs. We all say we like our MGAs, and somebody's friend is somebody else's foe, I guess. But at the end of the day, the model is there. It is going to persist. And we're going to have to, find a way to make that work. What I like about what MGAs bring is that kind of entrepreneurial culture. And I think what we as carriers need to do, and what I think the regulatory environments need to promote, is that we don't get bogged down in committees, and we don't get bogged down in what I would call excess governance that essentially makes us uncompetitive and slow to move. And then the MGAs will eat our lunch in that scenario. I think we have to be able to be nimble.
Yeah. Maamoun, you brought it up. We were going to get here. But, I guess going to Scott's point, show me an incentive, I'll show you an outcome. So let's maybe just offer the audience a way to kind of control this or set the right incentives, given that Christian I think we all believe they're here to stay, and it's a part of the industry.
Yeah, I mean, I think Scott articulated it really well. I mean, it is at the end about incentives.
Yeah.
And, if you think about broker facilities that have some skin in the game, well, how much skin in the game? And how much does that outweigh?
Is there a level that you're looking for?
Look, the way we like to think about this is the counterparty that has the pen ought to feel the pain before the carrier that doesn't, that offers the capacity. So there's many ways to structure that, but ultimately that needs to be real. And you need to understand those dynamics deeply. And I don't want to anyone walk away to think that my comments are that MGAs are a thing to avoid. I just think it's a thing to approach with caution. And it just comes down to incentives. At the end of the day, incentives drive behavior. And so you've got to structure around that, and you've got to think about, should things go poorly, how am I going to get reimbursed? So therefore, is there a collateral? Is there some sort of holdback financially that you can protect yourself against an entity that's capital light? So there's many things that go in mind, but it really comes down to just the incentives.
Okay. Before we move on to a different discussion, anything further we can add that we can give the audience in terms of how to structure these the correct way?
Yeah, it's about alignment. I mean, alignment is important through everything that we do. I like what Maamoun said there because, there are a lot of MGAs who will say that, they get paid on loss ratio. Most of them don't accrue it. The truth is they're getting paid on their acquisition cost. They're getting paid on their ceding commissions. And that's just upside. And if they get it, it's a nice to have. But it's not what materially drives behavior. Production is what drives behavior. Those are the ones that we want to avoid. It's become an increasing part of the business. I don't see it shrinking dramatically. I don't think it's quite as, some of them are more fragile than they may appear on the surface. They may have one carrier behind them, and if that carrier pulls the paper, the whole model falls apart again. So, like everything we do, we have risk coming in all sorts of different channels, and you just have to be on top of it and make sure that they're very much aligned with what you want to, do, and particularly if you have MGAs in long tail space, and that they got to be around for the results.
Okay, so we'll now move on to a different macro question, and I think Kevin mentioned it a little bit, but returns on equity have been good. Therefore, writ large in the insurance industry, valuations are pretty healthy, and we've seen a lot of pretty sizable transactions, right? So let's talk a little bit about the transaction activity. And again, Christian, to start with you, I mean, it's the ultimate.
We did sell twice in 3 months.
Yeah, exactly. So is this really a healthy time to sell? Is this? Do you expect transaction activity to continue picking up?
Okay, so I'm going to have to tiptoe through the tulips here. I think we're going to see heightened M&A activity. I mean, there seems to be the case, and to a certain extent, I feel like we kicked off a bit of an M&A arms race because we listed on May 8th, and then we actually announced an acquisition by Sampo on August 27th. So that wasn't the plan, but that's how it played out, and it was the right thing to do for shareholders. And that's the way these things play out over time. We were, back to your question about private equity. Apollo came in 7 years ago. I think private equity plays a very important role in the business because they take what are distressed assets and clean them up and fix them, and then get them back functioning. And so I think the fact that there is this much M&A interest out there in the industry right now I think it's validating the fact that a lot of these franchises that are there are performing well, they're producing good results. I think there is a theory that M&A is kicking off a little bit earlier, as growth is potentially slowing. There's some folks out there with a lot of capital, certainly the Japanese is the one that gets pointed to all the time, and we expect that to continue to be active. And I think the idea is that some of the M&A is starting earlier because there's interest in acquiring these companies while the pricing cycle is still stronger, and the results are still stronger. So yes, I think it's gonna continue. With that said, if it over consolidates, there's going to be some opportunity again for entrepreneurial folks to get out there and build some businesses, that are going to, fill a gap if there's, if the industry is dominated by too few kind of super large players as well. So yes, I think the M&A environment is probably going to be one of the biggest topics for the next couple of years.
Scott, how do you perceive this?
Yeah, look, I think it is, and it goes back to some of the things. I think Kevin mentioned it earlier on as well. Look, there's an element of this which is scale has a relevance. It's not the only thing, but there is a level of scale that I think is important to have. And I think if you look across the industry, whether you look in the US, you look in Lloyd's, etc. There's a lot of people you could say could benefit from scale. That's number one. Number two, there's a lot of privately owned assets. I'm afraid at some point they have to, something has to happen, right? And so I think there's a lot of them looking for the next twist. I think linked to the pricing cycle, I think some of those private assets are looking ahead and thinking is now a good time to get out, ahead of potentially a pricing cycle coming down, and everyone can have a different view on that. And then maybe back to what Maamoun said, which is there is surplus capital. And so my point is capital needs to find a home. M&A capital is not bad capital. It's just a different way of achieving strategy in the end, although you have to be very disciplined. So yeah, look, I think you are likely to see heightened M&A, and I think people will also use it as a pathway for growth. And there's a lot of valuations out there in share prices that are predicated on growth. And inorganic is a way of making sure that you continue that growth trajectory if it's done well. The only comment would be a lot of transactions are not done well. Yeah, and that's always the risk factor in taking on inorganic.
Yeah, Maamoun, how do you perceive this?
I agree largely with what the guys have said. Historical context on this is when pricing inflects and starts to go down, M&A activity picks up. So no surprise that we're seeing it. I mean, I think if you look at the teen years, it was in the carrier space almost one a month, almost, acquisition. So I do expect more will happen. I concur with Scott that there is this excess capital. M&A is an avenue for it. Lack of growth is another avenue. I think if you think in the world of Arch Re grew 7x in the last 7 years. Our view is let's focus on organic growth rather than be distracted with acquisitions and integrations and so forth. When you're growing 1.5–2 billion of new business a year, you need to be heads down on that, solving for clients. So I think that's the reality of when rates are up and there's opportunities to grow, you focus on that. And as things tail off, I think the general consensus in the historical context suggests that there'll be more M&A going forward. And frankly, I mean, the valuations have come off. You've got this sort of come togetherness of a lot of excess capital and historically lower valuations on the view that the growth isn't there. And as Christian mentioned, I think if you're up for a second language, Japanese would be a great second language to pick up today. That's idiosyncratic to what we're seeing today.
It's just this globalization almost of the market here, right? I mean, in that sense, Christian, kind of a seminal transaction, wouldn't you say?
Yeah, I mean, I don't want to talk about our transaction, but we had an owner who'd been in for 6–7 years, and they were, to Scott's point, naturally looking for an exit. I think the planets aligned, and that was the right decision. I mean, what we're focused on is, taking all of the things that we built that we think were really good about Aspen, and putting those into the merged environment and making sure that our people can thrive in that scenario. And I think when you bring the right companies together, these things can actually be better for both sides over time. And so I think the market has been quiet because I think, as Maamoun said, everybody was heads down on organic growth because it was there. We had an interesting experience going through that sale, and that we were literally hours away from getting ready to IPO, and then a trade war kicked off. And so we actually ended up kind of pausing, and then we actually went in the middle of a tariff war, which ended up working out okay. But it was an interesting experience. There was a lot of long late night phone calls, but it does seem to have kind of, opened the floodgates a little bit, I guess, for more acquisitions. But I think it was coming, to be honest. It was coming. And IPO activity has kicked up as well.
Right. Okay. Yeah, the cross-border nature of it, and I think clearly, I forgot who said it, we should all learn Japanese as a second language here, but I think that's a function of the regulatory regime, and it's probably a very positive sign for Bermuda as a whole, that there's whole jurisdictions who've become much more comfortable in
yeah, and I would still expect over time, Bermuda, I think, is still the best place to start up a business, and
yeah.
you can raise capital quickly, you can get that out there. I would still think that, as we've seen with the cycle, there is consolidation. If you look in the, how many of the class of 92 and 2002 and 2005, 6 are left. There's been a lot of consolidation, but then there was another round of startups around 2020 as well. So that's, it's going to keep coming. The cycle's going to keep going through. I think that's good.
Yeah. Maamoun, you wanted us to get here, but we've sort of caught a few good breaks on catastrophic events this year. Like even the California wildfires, I don't think have led to some existential loss issues. So is there any complacency that you worry about in the industry when it comes to thinking about and adequately, assessing risks? I think you were the person who first said widowmaker here. So are there a lot of widowmakers starting to get out in the market because of complacency?
Look, I think the primary area for complacency is natural catastrophe, and I think we, as an industry, we're sort of very, the latency bias that Christian mentioned. We're sort of over-indexing on what just happened. And I think if you just step back and think in a historical context, you think about the years, 17 to 22, those 5 years, industry lost money in property cat. 3 of those 5 years didn't have Florida landfall events. You go all the way back to 1992 with Andrew. The biggest event yet was an A. It was the first event, happened in late August. And so what that tells me is we just have to be careful about over-indexing on just what just happened. Property catastrophe remains primary peril for the industry. We're in a heightened environment of risk. And the historical results could change materially with a small tweak in storm paths. So yeah, I do worry that we wholesale make changes on this notion that there wasn't a 2025 event. I mean, I think that the November hurricane is just it's just around the corner when we can't close the doors on November 1st and fist bump in the air. And so yeah, I do worry about complacency around that, and I think you must price property catastrophe risk over a period of time, over a long view of risk. And as a reinsurer, you kind of lament this notion that if you make money a certain year, you've sort of sinned, and that you must do things to return it all and then break your nose, and then only then can you raise prices. And I think this sharp cycles in property cat are self-inflicted. And I always say this in-house, it is astounding to me that as an industry, we take capital stacks that are in the billions, and we put them all together in the last 2 weeks of the year, and they come together based on sentiment and who was tired that day and who over-negotiated. It's just a dynamic that, I've been in the business 32, I still can't wrap my head around. We've got all year to collaborate with clients and brokers and cast these pricings in ways that make sense over a period of time, but we refuse to do that.
Scott, do you agree with the complacency?
Well, he's just given me a tactic. I'm going to keep him awake one night outside his house so that he gets tired,
Yeah,
and I
it's
can
a
get
war
a bit
of
of deal
it's
as
a
a
war of
buyer. Yeah,
attrition.
so
Scott, I'm always the soft belly of the
he's
group.
given
Don't
me
worry.
great insight. But I remember sitting on this stage 2 years ago in a panel discussion when property cat rates had readjusted. And it was not about rating, it was about a correction. It was a price correction for risk. And I remember making a comment there that if you now came down here and looked at us as an industry and you were from outer space, I honestly think at times you must think we're lemmings, right? Because we finally get the risk priced correctly, and all we've done since that point in time is talk about the rates coming down. Okay? And I always said there is no question that when you do a price correction, there's an element of adjustment. Okay? You never get it right when you do a price correction. So plus or minus, you know, the rates need to be massaged and to get them to the right level. And then you've got the dynamic, which I completely agree with Maamoun on, which is, so the headlines are we've had no major events in Q3. Is that going to drive the rates down? I can't remember RDS models being based on quarterly events. Yet that's the way we talk, it's the way we discuss. And actually, I'm not laughing, as I said, because that is actually the behavior. And yet we fought so hard as an industry, having not made any money for a number of years. And so I do think we have to take a sort of long look in the mirror. I think the thing that was really important that came out of the price correction is that there was a realignment between primaries and reinsurers in terms of the frequency, you know, smaller frequent events. That has stayed. But the pricing, I do think at times we must look like lemmings.
I mean, we you know, there's times when we talk like we're, you know, awash in excess return. You know, we've covered our capital cost of capital
Correct.
2 out of the last 5 years. 3 in the last 5 years, if this year probably ends up, you know, going okay. So, you know, that's not that much to be crowing about, to be honest. It's, you know, this is quite affordable capital for people to access, and there, you know, there's just so much. Sometimes I think we might be the most over-reported industry in the world because the headlines that are just kind of coming through constantly about individual deals. I'm like, why is this news that so-and-so's deal renewed at, you know, +5 or -3 or whatever the number is? You know, there's kind of an over-fixation on that. When you know, we're building these portfolios that have to, you know, play out over time. And that's when the profitability is going to come through, and this kind of compounding book value approach it's what's important, but there is a kind of very short-termist kind of discussion culture in the industry, I guess, for lack of a better term.
Okay, well, just to move on, but great news. I have a great new industry for which all insurers worldwide can soak up their capital, which is AI and the data center revolution, right? So I think McKinsey has it that in the coming year, like very short order, $7 trillion in data centers will be constructed, and I believe those need to be insured. And so this is a whole new industry that's emerged, you know, fairly quickly with a level of spending from a handful of companies that's unprecedented. And so, is there this massive coverage gap that the insurance industry has for all of this spending for AI and AI infrastructure? Who wants to take the question first? But I think everyone should weigh in on this one.
I'm happy to jump in. Coverage gap, one thing, capital gap, another. I think pure math would suggest there isn't enough capital to handle this thing, but I actually am an optimist. I think this industry has been creative and resilient in ways to bring knowledge and capital together to solve client needs. So I'm optimistic that the industry will come around and find a way to insure these things. The first good sign is the industry has leaned in on the construction phase of these data centers. And there's a difference between a 25 billion single envelope and a 25 billion site. And so when insurers that have high engineering talent can go in there at the start and influence the MEP, like the piping of this stuff, and the fire separations and so forth, I think that's a new dynamic, and I think that's healthy. So from the start, we're leaning in as an industry, and I think that's positive. But this AI dynamic brings sort of things that we're not used to. Historical context isn't there. We don't have credible historical information to use our current products, our pricing isn't applicable. And I think it's uncharted territory, so this is going to be iterative. It's going to be a product that allows the industry to lean in and iterate the product, very much like D&O. D&O is unrecognizable as a product from when it incepted 40 years ago to today. I think the industry will lean in, will iterate, and eventually we'll get there.
What do you see?
Yeah, no, I'm completely aligned actually. I don't worry that the industry won't find a solution. I think the industry has always found a solution to risk, but it's new risk. And so the industry has to learn and it has to work in partnership. And given the scale that's involved, there needs to be a new way of working out how to protect the risk and bring the capital to the risk. But I have, to be honest, we can't not, right? And that's the other side of it as well, because it's the direction of travel. But we're a long way away from understanding it as well as we need to and should to price it properly. But I think we need to be prepared to learn.
Okay, and I think we're running out of time, but I'll leave it with Christian to add on to the data centers, and then just a final kind of a whopper of a question here. But
Okay.
we discussed it beforehand. But is from an insurance standpoint, the world flows through the Mag 7. So is that creating some serious accumulation risks for the insurance industry to manage?
So just on the data centers, I think I would say the important thing is to risk manage those, and they're essentially large industrial facilities. I think they need to be, engineered the right way. It's going to be an important component of that. Is there a concentration risk in the Magnificent Seven? I don't know. That's an interesting question. I mean, I think I read somewhere that 80+% of NVIDIA's revenue comes from 6 customers, and they're a $5 trillion market cap company. So there's concentration risk within the companies within the Magnificent Seven, and they're probably all commingled as well. So, that definitely feels like an arms race for AI. Whether all of that computing power actually is needed, I think is an interesting question, and if all of that investment can actually monetize itself and pay for itself, I think is another pretty open question. But from an industry perspective, I think we will try to figure out how to do that in a way to support the growth of AI as a sector. But again, when you're putting data centers the size of Manhattan in the middle of Louisiana, there's some things to think through, as a risk carrier in that scenario.
Okay. I hate to leave the audience with a great cliffhanger, but it I guess can have us come back next year. And thank you so much for a wonderful panel.
Thank you for hosting.